Hello, everybody, and welcome to the Tortoise channel. Very happy to have you here. And I'm recording this video because I want to update you on something important. So yesterday, I decided, after reassessing my portfolio, guess what? To buy more PayPal and Lululemon shares. So I just decided to load up the truck on these. And today I will cover the main essentials. Why exactly I decided to do that, especially considering that in the last video that was made yesterday and was posted here yesterday, I specifically mentioned regarding Lululemon that I wanted to see new developments coming from the Americas business segment, right? I want to see management executing on their strategy before deciding whether or not I should put more money to work, okay? But after reassessing my portfolio and after the stock has become cheaper, right? I just decided to buy more shares. Okay, so without further ado, let's just cover everything that you need to know. And let me know in the comments below if you find this helpful. And what are you doing? I'm not sure if you have both PayPal and Lululemon in your portfolio. If so, just let me know what you think, what your investment thesis is, and see if there is any alignment here. Okay, so I, as usual, decided to concise everything in a Word document, and I will be walking you guys through the main essentials, starting with Lululemon. Okay, so why did I decide to buy Lululemon? And before we go here, you can see if I go here to my Lululemon charts. Let me go back. You can see that this stock has been absolutely destroyed. Okay, so I mean this stock is about 60% from its all-time high, if I'm not mistaken. So if I come here, let's have a look. Yeah, about 70%. All right, and you can see that my average initially I had bought shares at about $201 per share. But then with the stock at 160, I decided to load up the truck. Okay, so you already have you already have the visuals. Okay, I use, if you are new to the channel, welcome. I always use interactive brokers to execute all my transactions. And this is where I keep the Tortoise portfolio that I started about 2 years ago with real money. And I like it to keep things very transparently. So at the end of the video, I'll share exactly the portfolio in what things look like. All right. But now, first things first, let me show you then my Lululemon thesis right here. Okay. So let's start. Yeah, starting with Lululemon, you can see that for me, at least, Lululemon definitely remains a buy. Why? Because they have a strong brand, they have a loyal customer base, and they have industry-leading margins despite recent stock declines. Okay, so I went to New York not that long ago, guys, and I was just astounded. I mean, the sheer amount of people that were wearing Lululemon pants, especially women, all over the city was just mind-boggling. So to me, that tells me something, and so. And of course, with the growth that they are experiencing internationally, and considering my experience while in New York, of course, that also allowed me to make this decision easier. But yeah, here we go. You can see that international growth in China and Europe is robust, right? They are growing very attractively, as you will be able to see. Significant room for further expansion in under-penetrated markets, supporting the long-term thesis. The main reason I decided to buy Lululemon instead of other apparel giants is exactly because of the growth prospects. I still think Lululemon, unlike Nike, for example, which has a stronger moat, granted. However, the growth runway for Lululemon is far more attractive if compared to Nike's. Okay, and that was part of the thesis. I wanted to invest in a company that can compound my money over multiple years at 15% or above, without me having to sell the stock. Okay, that would be the perfect scenario. And I do think Lululemon may very well fit that bill. Otherwise, I wouldn't have load up the truck. Right. So the thesis here is actually very simple. I think Lululemon is one of the easiest, is one of the simplest businesses that I have in my portfolio. The thesis is very simple. It's a very simple business to understand. To me, this is just a premium global brand with a strong balance sheet. So they have about 1.1 billion in cash and no debt. In fact, let me show you that right now. Yeah, these are incredible fundamentals. If I go here to my stock and lock platform, you can see exactly that. It's taking a while. Bear with me one sec. It's already here, Lululemon. If I go here to financials, you can see that, right? So you can see that they have no debt. So look, they have zero long-term debt, zero short-term debt, and they have about, as you can see, where is cash and cash equivalents, almost 2 billion in cash and cash equivalents, as you can see. So this translates into what we see right here, right? They are debt-free and they do have a net cash position. Okay, so this makes the balance sheet absolutely pristine, and all the more reason I remain extremely bullish on this company. They also have pricing power with gross margins around 59% in, like I said, deep customer loyalty, with more than 40% of sales coming from direct to consumer channels. Okay, and they have one of the lowest marketing spends as a percentage of revenue in the industry at around 5% of revenue. What the heck does that mean? I mean, just look at some of the biggest competitors that I highlighted right here. Let me see where that is. Right here. Okay, look at that. So I'm comparing here Lululemon with Nike, Adidas, and then Under Armour. Yeah, but you can see that Under Armour metrics really lag behind all these three. So they are just a lower quality business, if you ask me. But look at Lululemon, guys. So they have the gross profit margin sits at about 59.10%. Even despite all the headwinds, the macro headwinds that we are seeing, they still manage to have one of the highest gross margins in the industry, right? If not the highest. Nike, for comparison, sits at about 41, almost 42%, and Adidas at 51.22%. Now, look at EBIT margin, so operating margin, 22.82%. Significantly surpassing the operating margin of both Nike and Adidas. And now look at net income margin, 16%, more than double that of Nike and Adidas. And let's not even covering Under Armour because it has far lower quality features. And so this is just incredible. Does this look like a company that is struggling, or that a company that doesn't have a moat? What's even more significant is if you come here to their margins, if I go here to financials and if I go here to metrics, you can see that Lululemon's gross margins have been amazingly consistent ever since 2010. And the same happens for the operating margin. Look at that. In fact, they have been growing that margin, but the average is about 22, and right now they have about 23.70. So it's above the 10-year average. I mean, this is just an incredible company. And what this tells me is that they are keeping their pricing power, which is consistent with what we are seeing in the fundamentals. Okay. So in addition, more than 40% of sales come from direct to consumer channels, which is something that I also like. So for example, Nike has a lot of third-party relationships, right? They have wholesale partnerships. And what that does, it can happen is that dilutes the brand because these wholesalers can reduce prices sometimes even without the brand knowing, which is not good. But so what it means ultimately is that Lululemon, if that were the case with Lulu wouldn't have full control of its customer experience. All right. And I like the fact that about almost 50% of their sales are coming from these direct to consumer channels. Look at this. Let me scroll down right here. Look, company operated stores. And then you have e-commerce. Company operated stores makes up almost 50% of their revenues. Okay, very good. And even more attractively, if you ask me, at a time that we are seeing a lot of aggressive spending, just try to raise awareness of the brands and try to engage more consumers. You can see that they still maintain one of the lowest marketing spends as a percentage of revenue in the industry. It's just about 5% of revenue, which is just incredible. So let's look about sales and what exactly is happening right here. You can see that this is the big elephant in the room. So North American momentum needs to improve. This is part of the reason why in my former video, I said that I wanted to hold off on buying more shares until I saw the momentum picking up again. But as you can see, this is not updated, by the way. It still says that the average price is about $201 per share, but this was actually before me buying more shares at around 160. So this needs to update right here, okay? You can see where this arrow is and where I bought more shares. So my average price is actually lower, probably around 180, 170, 180, yeah, something like that. But you can, so let me go back. I want to see this momentum picking up again, because I think that's going to be very important. But the reason I bought more is because the stock got so cheap I mean, the company is priced as though there is not going to grow any kind of growth going forward. And you can still see from the latest quarterly report that aside, with the exception of the Americas, right, the international expansion is happening and is in full swing. You can see, for example, total revenue increased 7%. Guys, Nike's revenue is actually declining. So in many of these businesses, revenues are not increasing at all. Like, they are declining. So the business is contracting, while Lululemon's business is actually still expanding, though at a lower pace. But the revenue increased 7%. China mainland revenue increased 25%, right? Comparable sales jumped 70%. Rest of the world revenue increased by 19% and comparable sales increased 12%. So the international plan is being well executed. And like I said, things are looking very positive in that regard. And I still think the runway is just incredible. However, you have to account for the fact that America still makes up about over 70% of the company's revenues. And that's why analysts are a bit on the fence, because you can see that America net revenues increased 1% because they continue to open more stores. However, comparable sales decreased 4%. And this is what I want to see the company turn around. Okay, so what the heck is happening? What's happening, guys, is that you are seeing across the space that all these companies are struggling and their stocks are just crashing. It happens with Deckers, Adidas, Nike, Under Armour, all over the board. You are seeing a lot of selling pressure. Look, consumers are becoming more cautious, okay, about where they are spending money, but they are also more willing to try alternatives, which increases competitive pressure, as management acknowledged during the conference call. At the same time, another thing that management acknowledged is that they have essentially rested on their laurels. In other words, weaken newness, right? And some product mismatches also contributed to underperformance. And so these are part of execution missteps, okay, which in conjunction with the removal of the minis rule and tariffs caused a lot of selling pressure, not across the retailing space. And so, but most importantly, in the case of the Americas, and management really emphasized that, which is something that I really appreciate. They were very transparent. They said, we stopped innovating and our customers got bored, essentially. They stopped seeing people coming into their stores because they got bored with the products, right? They were always the same. And so innovation is very important. To create excitement is going to be very important longer term. And I want to see the company executing well on that. With regards to tariffs, well, I mean, tariffs are, this is a macro headwind. It's not something that will solely impact Lululemon, but you can see that with these retailers outsource most of their fabrics from third parties in Asia. So consider countries like Thailand, Vietnam. Okay, so if tariffs are high, for example, if you have 40% tariffs in Vietnam, what that means is that it will become a lot more expensive for Lululemon to actually buy those fabrics, to outsource those fabrics, because they will get additional taxation, right? So this, of course, will end up affecting margins. And we are seeing that. You can see that's exactly why gross margin decreased 110 basis points to about 58.5%. Even though, considering all these pressures, you can see that gross margin still remained at about 59%, which is crazy. So my point here is that Lululemon has enough wiggle room to take this to get hit with tariffs, and exactly because they boost one of the highest margins in the space, and that alone gives them a competitive advantage relative to other companies. Okay, and so this is what I wanted to say. What else did I want to say? Yeah, you can see we've already covered that. Outside the United States, performance continue to show as a brand, performance continues to show a brand with substantial momentum. Revenue in China is growing, also in Europe, international regions as well. Both regions benefit from strong demand for technical products, lower market saturation, and customers who are just discovering the brand. In fact, I visited 2 Lululemon stores not that long ago, and they were just here in London, and they were packed with Chinese consumers. And so I asked them, and many of them told me that, yeah, Lululemon is just booming in Asia, and they really like the fabrics, how they feel, how comfortable they are. So I like those things quite a lot. Okay, of course, I'm an investor. But what's important here is that all this expansion is profitable growth as well. So it's not just growth at the expense of margins. No, this is actually being profitable growth, because they have managed to maintain strong operating margins even as the company is opening more stores. And you can see in the latest quarter that they opened a lot more stores. So they have right now 780 stores, which is up from 721 stores just a year ago. Okay, so the global expansion is in full swing, and this is such a very profitable company. So look what management said, Calvin McDonald. We have closely assessed the drivers of our underperformance and are continuing to take the necessary actions to strengthen our merchandise mix and accelerate our business. We feel confident in the opportunity ahead and plans we have in place to drive long-term growth. I mean, he's the CEO. I don't expect him to say something different, right? I mean, so this latest bit, we feel confident in the opportunity. Yeah, of course. But the first part of this sentence is the most important one for me. We have closely assessed the drivers of our underperformance. This is essential. they understand where the problem is, and they are putting out, they are laying out a plan to actually tackle, to mitigate those issues, okay? To make customers feel happy again with the brand and come back even stronger. So look, margins remain a key indicator of competitive advantage. And what I see is a company that still shows stellar margins against the backdrop of all these headwinds. Okay, and yeah, I also love the direct relationship that they have with customers, because remember, you have to understand Lululemon's business model. So instead, you don't see Lululemon's advertising heavily like on the news, or like Nike does, or any other apparel giants like Adidas, right? And the reason for that is because they adopt something different. So they engage with their community. They develop partnerships with fitness gurus that are handpicked by them, okay? And they allow these people to actually go out and spread the word, which is something that I really love. It's a lot more personal, a lot more engaging. Yeah, that's what creates stickiness as well. Also, something that I wanted to say is that going forward is going to be very important to watch that inventory, because markdowns will be in this environment. Markdowns are a danger. So the company, for example, if the company is growing revenues at about 7%, but if inventories are growing at 21%, and that persists over a period of several years, that is a big red flag. Okay, because what that means is, when you are a retailer and you find yourself with a lot of inventory, you're going to have to mark down many of the items. In other words, what were meant to be high margin products, the company, because they are not selling at those prices, then they're going to have to lower the price for those products. That, of course, will impact margins as well. So I want to keep a close eye on the margins going forward. Okay, that's important. And margin pressive, yeah, exactly. And if markdowns were being a significant problem at this point, as many are pointing out to, then we should be seeing far lower gross margins. And you can see that they are actually going up, right? I mean, look at that. This is yearly. They are going up since 2023. So, I mean, we are seeing even again, even on the face of everything that's happening. Yeah, so what are the main risks here with Lululemon before we jump into PayPal? The main risks are, again, the big elephant in the room remains the US, of course. The US slowdown could persist longer than expected. However, things that are very good is that the Fed is on the cusp of lowering interest rates, and that creates liquidity. And with liquidity, we have to assume that consumers will have more money, of course, in the pockets. They will be less strained, and that will make them spend, all right? And so this could bode very well for a company like Lululemon. Product innovation might not recover quickly. Remember, management said that they were expecting the new season, like at the beginning. They won't expect meaningful results until the beginning of next year. Yeah, right, with the new season. But what if that doesn't? What if that doesn't resonate with customers? That is always a danger, of course. So inventory levels continue to rise. If that is the case, we can see pressure, and of course, competition from premium activewears like Aloe and Vuori will likely increase, particularly in North America. So, but competition has always existed, but now they are really they really have to pay attention to these brands. All right, okay. So, in terms of valuation, what I also wanted to say with regarding Lululemon, and there are different ways we can do this, but if I go here, if I go here to my to stock analysis, look at this. You can see that Lululemon. Look how cheap this is. They are currently trading at 167, and let's use the let's use the pre-tax earnings, yield that was made famous because Buffett used it again. And what you can see is that if you have a company with a moat, and if you manage to buy that moat with a pre-tax yield of at least 10%, that's like buying a bond that yields you 10% without accounting for any of its future growth. So if I go here to our income statement, switch this to the trailing 12 months, look at this is the pre-tax income. Let's take that, and if I divide the pre-tax income by the number of outstanding shares, trailing 12 months, that's about 1.1. You get pre-tax earnings per share of about 21. Okay, now if I divide this 21 by 167, which is Lululemon's share price, I get, and I multiply this by 100, I get about 12.6%. So buying Lululemon today is like buying a company that is yielding you almost a 13% return pre-tax, right? Pre-tax earnings return per year without factoring in any future growth, which is unbelievable because this is a company that is still growing. And not only that, they are still buying back a lot of shares at these low prices. So I expect that yield to actually increase nicely over time, especially if the company continues to deliver robust earnings with the stock price at its current levels. Okay, so huge margin of safety, as you can see right here, and but based on this metric, and you can see that, for example, the PE is only 11, guys. That's just, I mean, it's almost unheard of for a company of this caliber. So now, without further ado, let's jump into PayPal. Okay. And why did I decide to buy PayPal? PayPal is one of the highest conviction holdings in our portfolio. And I'm very bullish, needless to say. In fact, I'm bullish on all of them. But it's just, I'm just so bullish on PayPal. It's hard to imagine that this company hasn't really left the station yet. And I will tell you here why that is and why I think the market is significantly underappreciating this company. Look at that. The market doesn't grasp PayPal's potential and clearly underestimates the business. The low valuation multiples are unjustified even for a business growing only in the low to mid single digits. This company is improving again and accelerating growth rates, and while risks remain, for example, they are still growing their account metrics by 1% on a yearly basis. Yeah. However, growth rates, at least in the mid single digits, seem reasonable for PayPal. Look at this. These are the results, the third quarter key financial results, and you can see that the total revenue grew so year-over-year growth is about 7%. Does this look like a company that is dying? A 7% year-over-year growth? I don't think so. Look at the transaction margins, right? Year-over-year growth about 6%. That's also very good. Now look at this. Net revenue increased 7.3%. Look at the operating income increased 9.3% year-over-year. Diluted net income per share increased 31.3% year-over-year. Why? Because PayPal is effectively a cannibal stock. These guys have, since 2018, the company has shrunk its share count by about 20%, which is incredible. In fact, if I can show you that right here, if I go here to PayPal, you can see that. Let's go to our income statement in yearly. Look at the shares, the diluted shares outstanding going back to 2018. Look at that. Going back to 2016, look at that. That's about 15%. They reduced the share count by about 16% since 2016. What's even more incredible is that if you go to 2020, like only in 2000, from 2022, yeah, look at that. They reduced the share count by 10%. So PayPal is aggressively buying back its shares at low levels, which is exactly why that is unlocking a lot of shareholder values. Diluted net income per share increased substantially, and also free cash flow increased almost 90% year over year. Wow, that's incredible. Talk about a profitable company. Not only that, they beat on earnings, they beat on revenue, they beat on transaction margins, and they also raised guidance. So they are very bullish going forward, and they are still targeting free cash flow in the range of 6 to 7 billion by year end. And we will use this to our intrinsic value calculation later on this video. Later on in this video, okay? So, accelerating growth rates. Let's talk about the positives. Let's talk about why I'm so bullish on PayPal going forward. And you know that I'm a big fan of Alex Chris. I think what the guy is doing is just incredible. But you have to look at his background. This guy came from Intuit, and he was responsible for the in fact he contributed to a significant boom of the business while working at Intuit. I think it was something like 30% per year. So this guy knows what he's doing. He has a track record of delivering a lot of growth, and even though this is the first time he's working as a CEO, I can see, I mean, you have to be blind not to see how he's delivering on the execution plan. So during the latest earnings call, PayPal identified 4 drivers of growth. And you can see that 2 of them are part of what they call branded experiences, which include the Win Checkout and the Scale Omni and Grow Venmo. Particularly in terms of Venmo, Buy Now, Pay Later, this is very incredible because what PayPal is seeing is that the Buy Now Pay Later segment is growing by more than 20%, and PayPal is seeing a fundamental shift in shopping behavior towards customers buying now and pay later. And because PayPal has been investing in this area, I think they will be very well positioned to be at the forefront of innovation in the future and to capture a lot of the future growth in this space, right? And the data is just incredible. Look at that. $40 billion is expected. $40 billion is expected in 2025. Okay, that's the total payment volume, which is just absolutely incredible. And they will be locking in more customers because they are providing rewards as well, right? Which is cashbacks, all of that creates stickiness. So I like that. So this is just one lever, the buy now, pay later. What about Venmo? Venmo, look at the growth, guys. If you go to 2023, you can see that Venmo was not monetized at all. But now they prioritized Venmo monetization. And that's why they launched Venmo debit cards and Pay with Venmo, different features that allow customers to engage, right? Allow customers to be more engaged and creates an incentive for them to spend. And you can see that the growth is being stellar. So the expected growth for this 2025 about 1.7 billion. That's revenue, Venmo's revenue. And this is incredible. The total payment volume has grown by 14% per year. And you can see that is accelerating. Look at that. TPV mix across PayPal's platform. So Venmo in the third quarter 2024 was 8%. Now in the second quarter was 12%. And in the last quarter, 14%, growing nicely. Look at the branded experiences online, 6, 8, and 8. I want to see that growing, that accelerating. Branded checkout online, 555. This is the thing that we discussed, right? So this is what's making many analysts feeling a bit, well, that's why they are still on the side. It's because they want to see the branded checkout online to accelerate, and it's been stagnant since the third quarter of 2024. And then Another thing that they want is to drive PSP profitability, payment service provider profitability, by deepening merchant relationships. And this is including fraud detection, multi-currency settlement, and payment optimization. Okay, you look at the scale, next Gen Z growth. These are all the scale all they want to do, right? So they want to scale all these new growth initiatives, which include PayPal World, yeah, which gives them access to right now to about 2 billion customers worldwide, agentic commerce, and this is why they have been This is why they have been partnering with companies like Perplexity and ChatGPT. This, according to what they say, they are very bullish on the agentic, on the commerce. They say it's going to be the future of e-commerce. And I don't right now, if for example, if you go to ChatGPT, you can't shop there yet. So I don't expect people to start making purchases through ChatGPT, but I do expect that the next 5 to 10 years are going to be game changing. Ads, they've brought in this guy right here, Mark Greter. For those of you who don't know, this guy was built the entire Uber advertising business from scratch. And under his leadership, Uber advertising grew to over 1 billion, a 1 billion business with more than 500,000 advertisers globally. This guy has a stellar track record in PayPal. So PayPal brought him as well. Brought him on board. So I'm very bullish. I think he's going to do great things for PayPal as well. Not least because PayPal, as you guys know, has over 400 million active accounts. About 230 of them are 230 million of them are monthly active accounts, and they comprise both merchants, right? Because it's a two-sided platform. It consists of merchants and customers. And I think this guy has a lot of data to create a stellar ads business. And also crypto and stablecoin, which will certainly show a lot of upside potential as well. And they are tapping into each of these segments, all of which will grow revenues going forward. I have little doubt about that. I see a lot of potential, and I think PayPal will execute well. Okay. Now let's talk about some of the most important risks. One thing that I really like to see, of course, is I like the fact that, let me go back here. I like the fact that active accounts are growing year over year. The growth is 1%, but monthly active accounts are growing by 2%, right? And this is good. But as I already pointed out in previous videos, the number of payment transactions is negative 5%, right? And the reason for that is because, well, a lot of what's happening is actually intended. So PayPal for a long period of time, PayPal was growing at the expense of profitability. But what they've been doing, and the Alex Chris, is they have been getting rid of those large margin deals, okay, that were causing them a lot of that were not contributing to profitability, and that, of course, is why we are seeing the number of payment transactions declining. But you can see that while so the total of payment transactions declined, okay. The goal for PayPal will be to increase the number of monthly active accounts. Look, PayPal is already a behemoth. They have so many people worldwide, but I still think there is a lot of opportunity. I don't expect them to grow monthly active accounts by 10% per year. That's crazy. But I do expect them to accelerate this growth as well. And I want to see the number of payment transactions per account to increase, right? So ultimately, these two numbers will have to become positive, and I think we are on the right path to achieve that. And of course, lower growth rates for revenue, but right now, even you can achieve at current prices, even if revenue continues to grow at 6 to 7%, we can achieve stellar shareholder returns if PayPal delivers on its execution plan. And now let's talk about valuation, guys. And I want to show you something very cool. And this is a sign of significant underappreciation by the market. If I go here to PayPal, okay, let's go here to PayPal. Let's do something fun. If I look at the market cap, so the market cap is about 63.68 billion. Let's do that here. 68 billion. And if we go here to financials and to the trailing 12 months, and if we go here to our balance sheet, let's subtract cash and cash equivalents from the market value. And this means we have about 52,313. And if we divide this by PayPal's total assets, this means we have about 0.7%. What that means, guys, is that assets excluding cash are valued 0.7 times their fair value of $79 billion. Okay, and it's a sign that the market is really bearish on this company. And sure enough, if I even look at the intrinsic value, so I'm going to use the discounted cash flow calculator here, so you guys can have an idea. And look, management is projecting free cash flow between 6 billion and 7 billion by year end. So I'm going to sit I'm going to settle at 6.5 billion, okay, which is the midpoint of that range. So let's say PayPal is going to grow the cash flows at about 7% per year. And let's use a discount rate of 15%. You always know that I want to double my money every 4 to 5 years. And that means my discount rate is always 15%. I learned this from Philtown, and this is always the discount rate that I use. I know many of you will use 10%. And what's incredible is that if you use 10%, guys, and if you assume zero growth going forward, look at this. PayPal, so you have a share price of about $73 per share. What does that mean? It means that PayPal, the market is pricing PayPal as though its free cash flows are not going to grow at all over the next 10 years. To me, this is just ridiculous. Okay? It's just ridiculous. And but I always want to double my money in 4 to 5 years, so I use 15%. And what this tells me is that the market is pricing PayPal as though as though its free cash flows are only going to grow at about 7% over the next 10 years, which in my opinion is bearish, because the company is growing free cash flows at a much higher rate than that. Okay, and in fact, you can see that in the past, you can see that even if you go to the last 5 years, they've managed to grow free cash flow at about 16%. So, I mean, it's just incredible. It's just unbelievable. And so the question is, I'm assuming 13% free cash flow growth. And if you do that, you can see that the intrinsic value of PayPal should be around $100 per share. Okay, and from current levels, well, actually, this already has a significant margin of safety, because remember, I always use a higher discount rate. So at the minimum, it's intrinsic value, the price you should be paying for a company. Yeah, if you assume the free cash flows are going to grow at 13% per year, and if you want to double your money every 4 to 5 years, in other words, if you want to achieve a 15% compounded annualized return, you could pay a price of $95 per share. And PayPal is currently trading at $68 per share. Okay, significant margin of safety, and you can't give this stock away. And all the more reason why I'm so constructive on the company is because even if PayPal even if some of these segments are not are not don't turn out to, don't work out as expected, yeah, you can still have a lot of growth because because the market is so and well, heavily and appreciating this company, that all you need is just a catalyst, one of these catalysts to actually work for this thing to go ballistic. Okay, so yeah, this is what I wanted to share with you guys. And now, as I promised, I'm going to walk you through. So the portfolio looks as this. I continue to compound money at over 30% per year since launch, and you can see that I'm the only positions I'm currently down on are Lululemon, which I already brought my cost basis lower, exactly because I bought more right on the way down, and Evolution AB. With Evolution AB, I don't want to buy more shares until I see positive developments coming out of Asia. So, but yeah, very bullish on the portfolio overall, guys. And yeah, this is what I'm doing with real money, with my money. So if you guys want me to share more of this content, smash the like button, share it with people that might benefit from what I'm doing, and let me know what you think. Do you think PayPal, Lululemon are going to go up over the next few years? Are you bearish? Are you constructive? Let me know in the comments, and yeah, and welcome to the channel once again. Thank you so much for all the feedback, for all the great comments. Yeah, and let's continue to build wealth together.